Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, and I want to go over these, what everyone's calling the Biden loan level price adjustments that are going to come into effect or are in effect as of May 1st. I actually don't like calling it the Biden loan level price adjustment, just like a lot of the things that get passed, because it makes everyone see something through a political lens. And I can tell you, after doing this for 25 years, many administrations, many different government bodies have changed these loan level price adjustments, always tweaking them for different reasons. And do I agree with them? Do I think it should be done? Actually doesn't matter. When these changes get made, there's always going to be some good and some negative. And the truth is there is good in this and some negative. So it's really just knowing the differences without all the emotion behind it so that you know how it's going to affect your buyers going forward. And I did like a $400,000 purchase price. So we can just look at the actual difference between, just a few months ago to what's going to be going into effect on May 1st. I do like to look at rates here though. I was looking at 30-year fixed rates that end on Friday at 6.66%, probably not the luckiest number in the world. Remember, everyone's situation is different. We're actually going to be looking at loan level price adjustments, which is actually what creates different rates for different people. I did want to do like a tale of caution here that I thought was kind of funny. So UWM is a big lender that I work with as a broker. I believe MPA is Mortgage Professional America. This is like a national website that covers mortgage news. And I did a pretty scathing video of the 1% down loan program. Nothing negative against UWM, just what the guidelines are, that you can only be using 50% of the area median income, which means $35,000 in income per year to qualify for this program, which is basically no one in our market. And funny enough, I did a couple things on it. I did a Reels and an Instagram and Facebook. UWM, this national magazine, I guess, quoted me saying, Florida loan officer Rayce Robinson posted an Instagram video slamming the UWM program, noticing the strict AIM requirements to participate, which is what I actually did, which I stand by the video, but it is funny. We say, be careful what you put out there because, people do searches, they can hear stuff, and funny enough, mine got picked up on this national website. So anyways, I thought that was funny. Let's look at an example of a true loan level price adjustment scenario and how it's going to affect you going forward. Okay, so these are loan level price adjustments here. I could make this video super complicated. In fact, I redid this a couple times because it gets too in the weeds. But there are literally, if we go through this, and we're not going to go through this loan level price adjustment, but there are literally adjustments for everything: manufactured homes, second homes, investment properties, condos, debt ratios, which is new. And so too many to go over. I'm really going to key on what the difference is between somebody that had a 720 score and a 639 score on the new matrix, buying as of now a 720 score and 639 score. What are the differences in those particular scenarios? Here's what I did. Just to keep this simple, I did a $400,000 purchase price, and I did it at 5% down, 10% down, 20% down, and 25% down. Currently, this means as of before the changes, this is if you took we're going to just pick a rate, a 6.5% rate. Somebody with a different credit score would pay more to get that rate. All the adjustments that you see people talking about on the internet when they say 1%, they're usually talking about the cost of the loan, not the rate. Rarely do people talk about the rate in the lending world. So if someone says it's going to be 1% higher on a $400,000 loan, they're meaning that's $4,000 higher. If you look right now, all things being equal, taking the adjustments, if you had a 6.5% score, you took a $1,900 loan level price adjustment for having a 720 score. And you can see I did a chart all the way down to 25% down. If you were buying and you had a 639 score and you were putting 5% down, you can see instead of paying $1,900 for that 6.5% rate, you'd be paying $12,350. Now, and the way it actually works is no one really pays that $12,350 because what we do is increase the rate, which increases the yield, which gets that cost down. So in real, practical terms, somebody that had that 639 score, instead of getting a 6.5% rate, maybe they're getting a 7.5% rate or 7.25% rate to offset some of that cost. But just to keep it simple, we're looking at the same rate all the way down. When you look at this chart, so it does become clear on a couple things. One, this person with a 720 score previously, on the new rate sheet that's taken into effect, of the new loan level price adjustments, they are now paying $3,325. And the person with the 639 score that was paying $12,350 is now paying $8,550. So to be clear, because there's some confusion on this, the person with the higher credit score is still paying less, but they are paying more than they did before. And if you think of it as a chart, it's kind of simple. The banks or Fannie Mae is actually decreasing the cost on the bottom end and increasing the cost on the top end to offset that. But the people with higher credit still get better rates and still get better everything for having the better score. So it's not a reason to just not care about your credit. I kind of broke it down here just so you could kind of see it in a quick chart, because ultimately this is all that matters. At 95% or 5% down payment, you're paying $1,425 more than you did before. And at 5% down, you're paying $3,800 less than what you paid before. And a lot is made about this, and I actually think this is a positive since I don't get to set the rules. First-time home buyers that qualify for particular programs like Home Ready and some of the new ones that are out there, they waive all of their loan level price adjustment. So someone with that 639 score doing a Home Ready program, which is a conventional loan program, saves $12,350. That is the big changes in the loan level price adjustments. Again, good or bad, really doesn't matter. In general, what will probably happen is lenders will raise rates to offset some of these costs. I read an article that I kind of agree with when I look at the math, that most people on the upper end will now pay $40 to $60 more per month than they were paying before, because usually the loan costs get absorbed into the rate. And people that are first-time home buyers are going to qualify for more home and have more access to getting financing, because they're going to qualify for more with lower rates, and that's going to push more demand into the market. In general, I think it's good to help first-time home buyers. If I had any negative just as far as timing goes, if you look at the future here, again, I always say my crystal ball is broken, but inventory not really going up. Rates really coming down, not a lot yet, but I believe that's a trend that you're going to see continue, especially after the next Fed meeting, where they'll probably raise the Fed funds rate a quarter. But after that, I think you're going to start to see rates fall. Again, no one knows for sure. And more programs entering the market just creates more demand when there's not a lot of supply. So the timing of really allowing more demand to come online, yeah, as a lender, I kind of like it. As a realtor, you kind of like it, but it definitely creates a big imbalance in the market. So last couple thoughts here I think are important. One, I think regardless of all of these changes and things that you hear about, whatever your daily success plan that I've talked a lot about that you definitely should have, I think about is going to the gym. I have a particular workout that I do. If I go to a different gym that day, I do the same workout. And I really think your DSP should reflect that. Market's going to be good, bad, and different, whatever. The market's always changing. Your plan, you might make some tweaks, knowing some things. Like, for instance, right now, I don't think Zillow and a lot of these things where you buy buyer leads really pay off, because you need so many more buyers than what you needed before to get a contract accepted. And it's very hard to make the ROI work. Now, not to say some people probably haven't, but in general for most people, because Zillow and these other companies haven't really adjusted their prices to give you a better deal, so you're paying a premium for way less closings, and it's very hard to make that math work, and as far as my opinion goes. But I do think your daily success plan, what you're doing to get your reach out there, reaching leads and past clients, and all the things you're doing should be the same really almost in any market. If you're wanting to know how to build the DSP, go on to my class on Tuesdays. It is the biggest online gathering of real estate in the United States. We go over specific ideas that my team follows and that anyone that's in the mortgage or real estate business can do to successfully grow your business by using a plan. To do that, that's every Tuesday. Invites go out on Saturday. More importantly, if you have any questions on anything, reach out to me. I'd love to help. With that, make it a great day, make it a great week, and I'll talk to you soon. Bye-bye.